Okay, guys, Microsoft just announced, and it was 20-some quarters in a row of beating expectations, and they actually missed on revenue and EPS. So let me go through that real quick. This is their actual press release on their website. They announced revenue of $51.9 billion, which is up 12%, and they announced net income of $16.7, which is up 2%. EPS, as earnings per share, was $2.23. What were they expecting? They were expecting $52.378 billion. They came in at 51.9, and they're expecting 229 per share, and they ended at 223. So what does that mean for you? Now, remember, if you're new to this channel, I'm Paul. I'm a value investor. I could not care less about the quarter-to-quarter missing or not or beating expectations by analysts. What I care about is making conservative assessments and assumptions about the future. And as long as the company's still on pace to do that, that is great. Now, if you're going to tell me, Paul, without looking at analyst expectations, how did this look? I'd be like, well, wait a second. This company's huge, and they still had a 12% increase in revenue. That's pretty awesome. Yeah, the bottom line wasn't awesome. That's okay. Their biggest driver was Microsoft Cloud right here. That's what it talks about right here, okay? So overall, your assessment on Microsoft should not be worried about what's going on quarter to quarter. What you need to do, and what you'll see in all of our videos if you watch our channel over and over, you decide to stick to it, is you will see that if you stick to a conservative assumption for every company and buy with a margin of safety, you don't have to sit there and get stressed about what's Microsoft going to announce, what are they going to miss. We have a community up here. This community, even people in there will ask me, Paul, what do you think about earnings are going to happen tomorrow? I couldn't care less. I am looking for more long-term comments by the company. Do they see major headwinds that are affecting my future assessment of the company? You know, Microsoft's grown a lot in the last 10 years. And 10 years ago, exactly now, I was buying Microsoft, and literally every person in the world said I was stupid. Every tech person said I was dumb. Microsoft dead. You don't get it, Paul. You're an idiot. Now look at them. They're a huge company. So let's do a quick analysis by looking at well, first off, their stock. After hours, they're up $4. Oh, that's Google. Let's go to Microsoft. Let's go to Microsoft here. Microsoft's down $2 right now after hours, $2.55, 1%. Okay, so not a big deal. In the last year, they hit a high of $3.50 and a low of $2.43. And that low of $2.43 might have been hit today. Who knows? Nah, maybe not. But they were down $7. Say they're at $2.48. Guys, this is a huge company, and they're down from $3.50 to $2.48. Keep that in mind whenever you think companies can't fall 20 or 30% very quickly. Okay, that does happen. Your goal as a long-term value investor or long-term investor is to make conservative assumptions in the company and buy at a discount to that conservative assumption. How do you do that? Well, if you're new to this channel, use the stock analyzer tool here in our software. So let's first look at our 8 pillars. Now look at our 8 pillars here. It shows all check marks except for the 2 valuation metrics. The price to earnings ratio over 5 years and the 5-year price to free cash flow. Both are showing 41. Now 41 is a high number, but if a company has enough growth potential in it, they can easily justify that high number. But the question becomes, how much growth is needed to justify this high number? All right. Everything else, they're buying back shares. They have low debt. They have increased cash flow, increased net income, and increased revenue, and a high return on invested capital. This is a wonderful company with a great balance sheet. But remember, we split apart the stock and the company. Wonderful company, could be a bad stock price. So even though we love the company, we're going to avoid the stock. Or if we're lucky and the stock price is great, we'll buy the stock. So let's go use the stock analyzer tool right now to make his assessment. So with our stock analyzer tool, we're using an assessment of between 1 and 20 years. I like to do 10 years for all my assessments. And for a company like Microsoft, first thing we look at for everything is revenue growth, and you input your profit margin assessments, your free cash flow assumptions, your PE, your price of free cash flow, and finally your desired return. We show you your 1, 5, and 10-year numbers to get an idea. Now, Microsoft's growth has actually increased over the last 10 years. Why? Cloud computing. But guys, don't get carried away. The bigger and bigger the company is, the harder and harder it is to grow. So I go very conservative on these numbers. You might be like, oh my God, you're too conservative. So be it. I'd rather be too conservative than be more aggressive. So for my low end, I'm going to call it 4, 7, and 10% revenue growth. Keep in mind, 10% revenue growth would over double its revenue again in the next 10 years. That's a big number there. It's possible though. Profit margin. So I look at the last 10 years and they have 27% over the last 10 years, 31% over the last 5, and 37%. So it's going up probably because of cloud computing with such a high margin in there. So I'm going to do 28, 30, and 32. Free cash flow margin, I'm going to do 30, 31.5, actually 30, 31, and 32. PE. Now, guys, I think Microsoft's wonderful, but they don't justify a high PE. So I'm going to go 14, 16, and 18 PE, and then I'm going to do a 12.5% desired annual return. I'm going to hit the analyze button. Now, before we go look at the number there, guys, I want you to remember, this is not a number of go buy this right now. If it's green, do more research. You want to make sure you understand if you can assess that these numbers are accurate. It's more of a starting point. If it's all green, go spend more time. If it's all red, but close, maybe you go spend some time. If it's all red, but you're far away, but you love the company, add it to your watch list, which I'll show you how to do. And when it hits your price target, then go do more research. Don't waste your time doing research on a company that isn't even close to your price target. Don't fall in love with the company even more. Just move on to another company. So we hit the analyze button, and the stock is currently at 248. Okay. We have a low of 100, a high of 190, and a middle price around 140. So for me, I'm going to add it to my watch list at 190 and get notified. And that way I can go forward. And when it hits 190, the software and the app will notify me and I'll be able to do more research. Thank you very much, guys.